the meeting to order
Grand name of
at
Grand is
5:31.
It's the only other one I can think of.
Nikki, would you call the roll, please?
It's not.
Yes, Nikki Austin is present, Rich Jeffrey,
Present.
Eric Ekdahl,
Present.
Gary Ellison is absent, Teresa Keen,
Present.
Cheryl McGuire,
Here.
Del McGuire,
Here.
Bill Mossberg is absent, and Tim Wolf is absent.
Okay, we have a quorum, we are in session. Entertain a motion to approve the agenda this evening.
So moved.
Second.
Motion by Eric, second by Nikki. By voice vote, all those in favor signify by saying aye.
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 All those opposed, nay. Motion carries. We're on to our discussion of financial investment opportunities for referendum money. Lisa is here to talk to us about all the really cool stuff we're gonna do with bonding options, general obligation, anticipation notes, all that good stuff, right?
Yep.
Okay.
So I'm Lisa Boyson. I'm from Baird. We're headquartered in Milwaukee. We work with about 80% of the schools in Wisconsin. We had 32 of 39, I think, facility referendums pass on Tuesday.
Nice.
Was
That's
that
great.
last Tuesday? So super busy. So thank you for for calling this special meeting. I also was on a school board in Muskego, so I know what it's like to be on your side of the table, having somebody come and talk about a super complex topic. And so I've mastered over 35 years really trying to put it in high level terms for you guys to understand. And please ask questions as we go along. I'll keep it informal, but I want to just hit the highlights. And I've dove into detail with the administration last week, I think it was. We went into a lot more detail, but tonight it's just about what do you really need to know, what do we need from you. No answer, no action tonight, it's just discussion. We're just going to talk about how are we going to finance this facility project. So I am going to talk about interest rates because you're not going to go to a bank and borrow this money. Banks can't, they don't have that much leverage to be able to borrow $88 million to a school district. So we're going to be talking about municipal bonds, which is what you're going to issue. It's the lowest cost of borrowing for any municipality in the country, and then I specifically work with K-12s. We're going to talk about the financing plan and really about some of the goals that we have that you guys are going to nod your heads, yes, that's a goal. And then I'm going to put just a timeline at the end, and we're going to talk a little bit about bond rating as well. So this is my favorite chart. It goes back to, I used to say it goes back to when I started at Baird, but I started in 1988, so it's not quite, it's a little bit 30-year look back. And this is a 1-week index for municipal bonds. So every Friday this gets updated. And honestly, when it gets updated again this Friday, you're going to see a drop. So the takeaway is two things, well, three. One, interest rates obviously have spiked. No doubt. We had a really nice time frame in there where I was issuing debt at 1% and 2%. That's not happening anymore. It's spiked quite a bit over the last year. But when you look at big picture, we are still in a low interest rate environment. The dashed line is where we're at right now. So you look 30 years back, we're still in a really low, we're below average over the last 30 years. So I feel good about, don't look at the actual rate because that's nationwide. I think for you guys, you're going to be right in that high 4, low 5% range right now. And I feel good about that. And then the third is really the volatility and how the movement, it moves like this. But this is a 1-week snapshot. Within the week, within the day, you're going to see all kinds of movement for municipal bond interest rates. And I have my finger on the pulse. I watch it all the time. Well, maybe not actually daily because we get a 2 o'clock email. This is what happened in the municipal bond market. My email today said interest rates dropped 12 basis points, 0.12%. Huge drop, huge. So I'm already on the phone saying we need to start looking at locking in some bonds right now because rates have plummeted. So just a general feel for where we are with interest rates. What you guys really care about is let's hope we can stay in the low 5s to high 4% range when we go to lock the long-term bonds. Okay, I'm going to spend a little time on this because these are kind of my big picture, highlighted bullet points. On the left-hand side are my goals. And my #1 goal in this whole financing plan is to make sure we do what we told the taxpayers we were going to do. And that is increase our debt by $1.99 and our overall by, 13 cents, okay? We are there, we've hit that target. You guys know that because you just adopted the tax levy. Okay, so you can feel good to say, hey, we said it was gonna be this and it was. Next year, we wanna keep it there or lower. That's a kind of a sub-goal there. It's really hard to say now because we don't have a state budget. My next goal is to minimize your total interest cost on the borrowing. Okay, so when I talk about volatility, locking in when there's a drop. Because 1 basis point, I think was $112,000 in interest cost. So if you borrowed a 4% or a 4.01, the difference in dollars is $112,000. It's huge, right? So we want to make sure that we're locking in the lowest interest rate because there's so much volatility, and the lower the better for taxpayers. Make sense? We want to minimize our interest rate risk, which is inflation as well, but really the interest rate risk. And when I say that, I'm talking about that change. You want to try to minimize getting yourself into a situation where we're in a spike. So again, that's all falls into me following the market and making sure we're locking in on the right day. And another factor that goes into that is trying to get borrowed as soon as possible. And that actually leads into the maximizing investment earnings. So you guys are going to borrow this money and you're going to be able to deposit it into an account and earn interest. Why is that important? Because $88 million could earn you over $5 million in interest. That's an estimate right now. We don't know the exact number. We'll know as we get closer. But all of that interest that you earn can go towards projects. So when you had that community forum and everyone was asking how did you come up with that $88 million and why, that was 2 years ago, and we've had, maybe not 2 years ago, it was a while back. We've had inflation since then. You can know in your own mind that you're going to have more than $88 million to spend on projects. Huge bonus. I'm telling you, if I was standing here 2 years ago, it would have been close to zero, because what was our reinvestment? Our banks were giving us, what, 0.1%, and it was nothing. And now they're giving us 2 and 3 and 4% earnings. So it's really good for you guys. But the sooner we can get that money deposited, you're going to earn $6,000 a day. $6,000 a day of investment earnings. So to maximize that earnings, we want to get that money borrowed and invested as soon as possible, so that you can continue to build. Does that make sense? Mm-hmm. Okay, so those are kind of my goals. Now when we look at the financing plan, again, super highlight just what do you guys need to know, and one of the biggest pieces that you're going to want to know is bond rating. So we're going to go to Moody's Investor Service or Standard & Poor's. There's 2 rating agencies. I've dealt with both of them. I've been on thousands of calls with these analysts. I know what they're going to ask. I've studied you guys. I studied you guys in the last time you borrowed, and you're going to be better off with Standard & Poor's. They're going to give you a better chance at a better bond rating. I just know that because I just know the questions that they're going to ask. So without diving into the detail of that, I'll just say we're going to go to Standard & Poor's. We're going to say, please give us a rating on these bonds. Why is that important? Because the lenders, it's not going to be one lender. It's going to be mutual funds, banks, money markets, excuse me, insurance companies, grandma and grandpa, banks. There's going to be a whole list of investors. They want to learn about you. They want to know about you. So what they're going to do is they are going to look at a 30-page document that we're going to put together about the district. We've talked about it, called an official statement. And stamped in the upper right-hand corner is going to be your bond rating from Standard & Poor's. If it's a B, many investors will toss it in the garbage. If it's an A-, some investors might. If it's in the high A category, which is where you guys are now, you're going to have more interest. And even higher in the AA category, you have a bigger pool. So the higher the bond rating, the lower the interest rates. So again, my goal to minimize your interest cost is to get the highest bond rating possible. Let's get the highest bond rating possible. So what are some of the basic questions? I'm not going to go into a lot of detail. I sent you guys this. I don't know if you got a chance to look at it. we're gonna add to this. This is just a preliminary draft of, I tried to pull up 2 school districts that were rated 1 notch up to see if we could get you there. And I'm still a little queasy, I'm not gonna lie. It's a lot of debt for a district your size. And that goes into the rating. It's out of your control. You don't have any control over that. And an A+ is a great bond rating. If we can get upgrade to a AA-, which is the next level up, you can see in that box in the bottom. You know, you're talking, what do we say, 10 basis points, or over $1 million in interest costs. Something to that effect, yeah. So it's a lot of interest cost that would be reduced if we could get a better rating. So again, we're gonna do our best. We're gonna try to hit the real strong points, the size of your tax base, the growth in the district, the high enrollment, the not the debt. We're gonna try to sidestep that, although it's gonna be very clear that, you know, you're gonna have about more than half of your debt limit used. And Southern Door County, who's an AA-, has 15% of their debt limit use, so it gives an idea of where you guys would be at. But we're gonna also talk big about your policies and practices as a board, your fund balance. You guys have done a great job maintaining a really strong fund balance. You guys are at, I don't know, the one. You guys are at, what was your fund balance again? You said it was 20?
We're just under 30, so.
Just under 30. I mean, that's a strong fund balance, so good job. So we're going to really talk about that and how maybe it's been built over time. And we're going to also talk about the local economy. And I put it on the administration to really help us do some research. What are kind of building our new subdivisions, new additions to a hospital, new quick trips, new, I don't know, whatever growth you can find in the district, we're going to try to lay that out for the rating agency. And I hope some of those factors offset the amount of debt. And I think they'll also hit the socioeconomic, the adjusted gross income, and those kinds of income levels in the district might pull, not get you to the AA-.
And our
So,
valuations, our valuation per pupil
Yes.
is low in the
Yes.
state.
yes.
That's why we're highly aided district, is
Yeah.
because we have low valuation per
Yeah,
pupil.
good point. It's a really good
So
point.
we're currently an A+,
Mm-hmm,
and if we go out for a new rating,
mm-hmm.
is there a risk that they're gonna be like, huh, you're actually, like, is there a risk of us going down? Like,
Eh.
what's the risk?
There is a risk, but I'm 99.9% sure you won't. If you said to me, oh, you brought your fund balance down 15%, you know, it dropped in half over the last 3 years, or you severely declined in enrollment, or you had no good fiscal policies. You guys have good fiscal policies. You have a fund balance policy, you have the investment policy, you have, you even have a debt policy. They look at that. They look at, you know what else they're gonna look at? These two.
I was gonna say, we have Ron, and he brought us from, where did you say, Ron, years ago? We were in the hole, right?
5,000
And we were triple,
And
B
so
minus
like
or-
historically,
triple
he's
B,
brought
triple
us
B
up to
minus, we
this
were good.
level,
Yeah.
so I think that should count for something.
So we're gonna get on this call with the rating agency, and they're gonna be listening to
Okay, good.
these two guys talk.
That's
and
awesome.
they're gonna be so impressed. And they're gonna feel confident that this district is very well managed and have two very good experienced administrators that are helping lead the
Good.
district. The other thing too is sometimes I'll say when you have a lot of debt, and I think we talked about this, you know, this is gonna get you for the next, what, 10, 15, maybe even 20 years. I mean, this is gonna be, you know, you're not gonna be going back to voters in the next 5, 10, 15 years. Would that be a true statement? I mean,
yeah.
Better be.
And I think that's
Better
the,
be.
and I think that's the what we have to sell, right? Is it's not that we have a lot of debt because we traditionally carry a lot of debt or we've done a lot of things. We're basically soon to be, would have been debt-free.
yeah,
We are building a high school. A high school is a huge investment in our school district and in our community. And when you build a high school, you take on debt.
yeah,
You can't control that.
yeah.
And I think they'd be able to understand that. This isn't like we have 3 other buildings we're paying for, plus now we're adding another.
Right.
This is it. This
Yeah.
is our debt.
And plan.
we've approached this planfully.
Yeah.
We've cared for all of the buildings
Right.
all along the way over the last 6 years.
Yes.
It's been building to this moment.
Yeah.
This is the last large capital lending we need to
Yeah,
go.
and we talked about that. how much we've planned to get to this point, you know, what we've done up to this point, how we've maintained our other facilities up to this point. So again, a lot of those factors will stress, and, you know, in the end, it is what it is, and I think an A+ rating is still a great rating for a district your size. So we will know, have an answer to that sometime in the spring, so January, February, March.
And
Sometime.
so, question Teresa didn't ask, but also will, you know, so in hindsight, that you understand is, you know, our rating is now 12, 13 years old, I think it was about 2010, 2011, right? And so you want to have a rated bond when you go out on the market, because if you don't have a rated bond, or your rating is really super old, people are like, do I really trust this?
Okay.
Why didn't they go get a new rating? So even if we don't get an increase, it behooves us to pay the money to go get rated again.
Yeah,
I just
non-rated,
didn't want to be
Yeah, no, I agree with you.
yeah, no, you won't get, you won't get. If there was any chance of that, we would be talking about it, but you won't. If you were non-rated, your interest rate would be, you know, 0.5% higher. So 5 million, or I don't even know what the math is, but it's a lot. You would pay a lot more. You would have a whole different pool of investors, and they would just throw out high rates at you, and yeah. Yep, so we're gonna go for a rating, and let's hope for the best. So I'll keep you guys posted on that. We're gonna work hard between now and January, February to get prepared for that. It's a 1-hour phone call. Any board member is welcome to listen, and if you're interested, I mean, we can give you the, I don't know if I think we're still doing conference calls where we're not doing like a Zoom or a Teams. That might change, but right now we're just doing calls. So you're welcome to join us as well. Like board members, I may be in your office for that too, so I can do this.
That was gonna be my question, so you're leading that call and then they're asking questions
Yeah.
to these two?
Yeah, and we'll prepare, and I'll have a list of questions beforehand, because I know what they're gonna ask. Yeah, so.
Good.
Okay, so let's talk a little bit about the repayment structure. It's 20 years, the bonds, when we actually issue the final bond issue, it's gonna be for 20 years. Because that's something, and right now, we're looking at a 10-year call or a prepayment date. So in 10 years, you can pay them off, not like you would, but we're looking at a 10-year. If I can push it to 9 years without hurting your interest rates, we'll decide that on the fly, like literally like a day or 2 days before, because that's another part of that volatility. If I put a 9-year call in there, and I know you're gonna get better rates by pushing out to 10 years, because investors like the longer they can hold the bonds without being paid off, the better, then I will. So that's a interest rate determination that will look at the market right as we sell. So, but sometimes you guys will get asked, you know, when is the call, or when can we prepay that, and that would be in 10 years. That's what I'm going to start with. If I can do better, I will try. And again, right now we're targeting the $1.99 for debt. Remember, combined it's 13 cents. And you did a great job trying to explain that. I know it was a point of confusion before the referendum, but I think we got it. Okay, so to minimize interest cost, to maximize your investment earnings, to minimize interest rates, we are setting up a structure where we're going to do a bridge loan or a short-term note first. Kind of like a construction loan if you've ever built a house. You get them funds first, and then once everything is in place, and I'm telling you, January, February is a much better market from historically speaking than December. So we were going to do a bridge loan first. We call it a bond anticipation note. It's a 6-month note. You pay it off in like 3 to 6 months. And that way we could get it invested as soon as possible. It's the quickest way to get funds. Okay, so that we're going to have you guys adopt a resolution on the 28th for that note. We're going to lock it in right away. Close end of December.
How much will that be for?
88 million. The full amount. So we can get that invested right away and start earning $6,000 a day in earnings. And the soonest we can close, it might be mid-December, I can't remember. They're kind of all mixing together right now, but we're doing this in every district, so we're doing a lot of closing in December. Probably mid-December, but it's basically as soon as we can. And then we will wire the funds to one of 2 firms that take in bond proceeds, because banks can't. It's too much money for a local bank to be investing. So we would go with one of 2 firms. We're still looking at that. Both of them are very good. Both of them you've been working with American Deposit Management, they would take the funds in, and essentially what they do, and I'll let them speak for themselves, but they take like $245,000 chunks. So it's FDIC insured. Because the FDIC insurance for banks is $250,000. And they just take those chunks and invest in banks all across the country in CDs, which is the highest yielding investment legally you can do for the state of Wisconsin. So it's secured, it's collateralized, you get your principal back if the bank shuts down. But it's the highest yielding investment right now. There might be a mix of treasuries, US treasuries in there as well. So all of that would be invested, and that's not Baird's job. Baird's job is to get, sell the bonds or get the funds to you, and then we go independent to another firm to help you invest and maximize those earnings. And they look at the draw schedule, they look at whatever C.G. Schmidt, C.G.
Yeah.
Schmidt, right? Okay. Whatever they say their monthly draws are, so they need 100,000 in month one of 24 months or however long it takes. And then they'll build a ladder of CDs to mature to hit those draws. Does that make sense?
Yeah, so what will happen on the 28th is, we were looking at a 12/14, was when the close is.
There you go, 12/14.
I'll verify that with Lisa tomorrow that that's still the case. And then what we will do is I will send out to ADM and PMA and say, as of 12/28, that morning, that day, I want you to look at your rates, contact your banks, look at the US Treasury rates, because for some of the short term that might make sense. And by 2 o'clock that afternoon, I need to know what your investment schedule looks like.
And you meant 11/28, right?
11/20. And so, what does that investment schedule look like? What does, your fees schedule look like, that you're building into that? What is the anticipated net return? So we can look at those two and see where they fall, and then we can make a decision as to that and the services that they offer, which of the two firms we want to make to work with. And so with ADM, we already have the resolution in place, so if we would select ADM, we just select them. We would have a secondary agenda item to join the WISC consortium, or a resolution to join WISC, because if we select PMA, then we have to become a part of the WISC, which is the network of investing that they have set up. So we'll have all that, and you won't have it in advance of 11/28, because I'll literally get it that afternoon, because with the holiday in there, that'll be the day that they pull that all together. And so we then, as Lisa said, we'll have them, that'll give us 2 weeks. ADM, we have our accounts set up. If we would go to PMA, we have 2 weeks to set up our accounts. And then they just, on the day the band closes, put the money in there. They update their investments based upon the best of that day, and we go forward from there.
Yep, and we work with both. I work with ADM more, but we do work with both firms, and they understand the process, and they know how to set up your accounts, and it's just seamless. It's so much, it's less work for you. We put all the closing documents together, and so does bond attorney. So, okay, so that's kind of step one. Then step two is going to be after.
Can I ask a quick question? So the resolution that we're going to pass on the 28th does exactly what? It allows us, it
Locks
allows
in the
the
rate.
sale, it locks in the rate.
For the short-term bridge loan.
Is there any advantage, and do we have to do it on the date that you lock it in? Or do we have a resolution that grants authority so that you can select the best day between now and whenever to do that?
That's the second resolution.
That's the second resolution?
So the first one is the bond
Okay.
anticipation note, you just approved that. And the second resolution, and I've been doing this for about the last, I would say 15 years, and it works so nicely, especially in a market like we're in right now, is that that second resolution is gonna lay out all the parameters of the bond, the 20-year loan that we're getting a rating for in January, and we're gonna probably lock in end of January, February. The second resolution gives parameters for us to follow.
Okay.
And that allows us to lock in any day. Any day. Once we have that bond rating in place, we go. And
Okay.
so if it's a Monday and I see that there's Chicago Public Schools is on the docket, and so is Pennsylvania Turnpike, and so is, Madison, Metropolitan, whatever, school district, or the tech, whatever. I'm not gonna pick that day, because people aren't gonna be interested in Monroe, they're gonna be wanting to bid on the big one. So we may move to Tuesday. or if like CPI or KPI comes out, or non-farm payroll, or something that, or the feds meet, those are days I stay off of. So we watch on a daily basis and we can pick. And other flexibility options, there's structure flexibility. I can change the call date, like I said. I can change the payments if we know more about maybe with the state budget, or we're gonna give me more flexibility. I can do that, and we can sell to your local bank. So we can work with any local bank that might be interested in investing in some of the funds. And it gives us time to do that. So again, 2 resolutions on the 28th, one for the ban and one for that, the parameters of the bonds. You'll see the debt structure, which is the next slide, which is a lot of numbers, so I'm not going to dive deep into it. Oh, I'm like, can you change? So, yeah, so I mean, there's a lot of numbers here. This is financing plan, probably number 15 or 20. We've went through a lot of different iterations to see if we could still meet, which what I always tell boards to do is go to that bottom right-hand corner, and that green box is $1.93, so we're under the $1.99. And then the blue box gets us to, the blue box is your payments. Those are, and I mean, above it is too, but the blue box just shades equal payments every single year. So from a tax levy standpoint, when you guys adopt your tax levy every, at the end of October, a portion of that levy is gonna be debt, and that's that column right there. So it's gonna be next fall, it's gonna be somewhere in the 5 million, and then it's gonna step up to about 7, and then it's gonna flatten out at 7. So a bottom right-hand corner tells you where the mill rate is right now. This isn't the final plan. The blue box shows you the structure. I'm hoping I can get up higher a little bit on that. We'll have to talk about that. And then the $4.99, and it's not just because I wanted to be under 5 either. What they did is they took current market rates and added I think it was 30 basis point cushion. So the rate of what we borrow at. You guys, that would be the 3 things I would focus on if I was a board member, if I saw this huge plan and all these numbers. What is the tax impact, what is the debt structure, and what is the interest rate? Because that's what you're going to be asked. That's what people care about. When you're in the grocery store in the corner, you can say, wait, you borrowed at $4.99. Well, in this case, it's $4.99. Let's hope for $4.99. So yeah, this is a working document. It'll change. Okay, last but not least is the tentatively timeline, and I always like to highlight, what is the board, what is important for the board to know, and it's really tonight, we're just discussing so that you have a good understanding of what the financing plan is going to look like, and then on that 28th is the 2 resolutions that will be on the agenda. I'm hoping to be back here on the 28th, if not virtually. I'd rather be in person so that if you have any more follow-up questions, I can answer before we adopt those two resolutions. And then the rest of the work is on us. So it's getting the bond rating in place, marketing the bonds, locking in the interest rates. Once those are locked in, we'll let you know that A, we met all the parameters of the resolution, B, we have the final lock, and then we'll be able to give you that final financing plan that you just saw with final tax impacts and those kinds of things. So, and then after that, we'll work with ADM or PMA to pay off the ban. And then your first payment is in September, which we've already budgeted for. So we've got those funds, we'll have those funds in hand in February. So that's kind of a tentative timeline as it is right now. Questions, comments, anything that maybe doesn't make sense?
The phase 1 net interest for the ban. So the net interest is $933,000, and we're expected to accrue how much? So that the cost of the ban.
That's a really good point. It's a flat yield curve right now.
Okay.
In a normal yield curve, I know it's probably confusing, but when you invest in a 1-year rate, it's going to be low, and you invest in a 30-year rate, it's going to be high. Well, the world right now is flat. It's flat and somewhat inverted. So the short-term ban rate is going to be a little bit higher. That's why we're able to get the higher investment earnings as well. I think it's going to be, I don't know what it's going to be. I don't know what it's going to be. because there's so much fluctuation in the short end, I don't wanna say 4 and then it come in at 3 or come in at 5. But it's gonna be somewhere around there, yeah.
And this isn't Lisa's side of the world, but, you know, the other firms, one of the things that what they will do is they will also have to basically keep their eye on the rebate arbitrage, which are IRS terms of basically, we can't borrow money to make money, all right? So we can't borrow money to bring back in more dollars in interest than we do, and if we do borrow the money, we have to spend it within 2 years unless we make some other, you know, there's other things that qualify you for. And so they will be monitoring that aspect of it. And it's not always, as Lisa will tell you, always terrible that if you are making enough interest that you have to hit that, right? You don't necessarily invest at a lower amount to make sure you don't have to do that, because you want to get as much investment income as you can. But what they're monitoring is to make sure that you don't cross that threshold and then not give the IRS the money they're due, or you'll be in trouble. So.
Yeah, so if you borrow at 4% and you get 5% on your money, and you don't hit the spend down, which I don't think we're gonna do because it's such a big project.
Right, so
although it's one school, so it might. But if you don't hit the spend down, then that difference between the 4 and the 5% has to be rebated back to the IRS. It's a big, huge calculation that 3 firms in the country do. It's called arbitrage rebate. Don't worry about it. Just know that if you can get 4% on your money, good for you, right? I mean, that is just, it was so unheard of a year or 2 ago. So and I think that, you know, because the other option is you could wait and, you know, borrow maybe half and then half in a year so that you hit the spend down. Because we used to do that back in the like early 2000s, 90s. You know, we used to borrow some now and wait until you hit those spend downs so that you could earn more than the borrowing rate. But that to me puts you at so much risk right now with the market. I don't know where interest rates are going to be a year from now. I would hate for it to be up to 6% and then you're stuck. So I took the risk out.
You don't want to lock in
of
for
it.
20 years at a higher rate because you waited to potentially avoid
It made
rebate
sense
arbitrage.
back in the day. It did, because the world, it was a different world. It was a flatter market. It wasn't so volatile. So anyway.
In that example, does the, 5%, 4%, does the IRS get the full percent then?
1 full percent, yeah, the difference between the 4 and 5 gets rebated back.
Yeah, I think there's isn't there like a 0.125% cushion or something in there?
Something like that.
So there's a tiny little bit of it they don't get, but yes. most of it.
Honestly, I don't remember the last time I've seen a district have to rebate.
Right?
And we have an opportunity to try to do some things at ABE though, right? So any
Yeah.
of those proceeds could be spent almost immediately at ABE.
Yeah, so there's periodic time frames that you can hit, and then there's the end of the project time frames, and so,
Okay.
yeah, those are all the things they look at, and then we look at it to say, okay, what are we paying, when can we
Yeah,
pay it?
it's like 10% in 6 months, 50% in a year, 75% in 18 months, and all of it in 2 years is your requirement. And you may or may not, I mean, it's likely.
But if you're under, then it doesn't matter,
It's
right? So,
likely
and
you're
right now,
under.
the short-term and the long-term rates are so similar,
Yeah.
the odd that you're going to be over by any significant amount isn't that much.
So on the
But you're gonna
28th,
be pretty close probably.
so on the 28th, what you wanna know, you as a board member, you wanna know what is the rate that we're earning. Overall, in the whole portfolio, are we earning 4%? Are we earning 3.5%? Are we earning 3? Get that number and keep that in your mind, and then when we go borrow the bonds, whatever that rate is, if it's 5% or 4.50, then you know there's no arbitrage issue. Now, things can change within 2 years in that investment
Right.
portfolio. You know, they could pull money out, reinvest it in higher, but for now, we know that they're, so let's get the rate, and then I'd be curious to see what the rate ends up to be, because it keeps changing. And then we'll watch what the bonds are, and it's a really good chance there's not gonna be an
Yeah.
issue.
There's, much like Lisa on the borrowing side, the rates are changing much more rapidly than we've probably ever experienced in the last 20 years, certainly, in the last year. On the investment side, it's the same thing, and that's why getting an update on the 28th is much more meaningful than having had an update today,
Yeah.
because the rates are changing that quickly.
Yep.
So, and one thing semi-related to this too would be, even once we lock this in at an interest rate, 5 years from now if rates drop, we can refinance the debt.
Well, we gotta hit the
No.
call, Dave.
Okay.
10 years.
No,
9 to 10?
well, yeah, actually, we used to be able to refinance in advance of McCaldy, but Trump took that away from us, so we can't do that anymore.
Okay, I said
But
that.
we can do it using taxable bonds, so if we do tax, and I've done that, I've done taxable
If it
bonds.
goes low enough,
Because everything, when they got low enough, we would issue taxable bonds to refinance, and then you're fine. It's only if you do tax exempt, which carries a lower rate. But you're right, I mean, we could do that. if we-
but there was a time when, yeah, you could turn around
Yeah.
and do it pretty quickly.
Yeah, and we did many times, so, but, yeah.
So you had mentioned taking the proceeds and splitting it amongst all the banks for the FDIC insurance. Why not just put it in treasuries and be done with it?
Because we wanna maximize our earnings, so
But the banks pay more in CDs than a T-bill?
sometimes.
Yeah, it'll be interesting to see when
Right.
the two make their proposals, right? Because, you know, I saw their initial ones, right? And I know, you know, there's treasuries right now, there's a sweet spot where the short term, like for maybe the first year, treasuries might actually be beating CDs, likely are beating CDs. You get out to when you need your money out past 12, 14 months, then the CD rates start to catch up what they're expecting the treasuries to be. So,
And that's really when it matters, is when you're out further. But I'm telling you, in April, that wasn't the case. Treasuries blew away CDs.
Right.
Everything was treasuries, but now CDs have come back.
yeah, so it gets into that, because treasuries have, you know, periods of if you hold them to the end, right, that you know what you're gonna get, otherwise you're kind of on the treasury market, right? And so if you ladder yourself into that, the rates sometimes move a little on them, so you can't just look at just what the treasury rate is.
Yeah.
But I think you'll see that, Eric, I think you'll see, depending upon where they are on the schedule, treasuries might
Okay.
rise to the top for a period of time, and then it might be CDs, and it just all depends on when you need that money, based upon the draw schedule from CG Schmidt.
But essentially, you're confining yourself to low-risk CDs and Ts.
Has to be,
Yeah.
yep.
Yeah, all right.
State statutes.
I mean, it either has to be FDIC insured, US treasuries, or collateralized. And so, you know, it has to be fall into one of those three.
Yeah, you can't put it in the stock market, unfortunately.
How are we paying you? Like, how do we pay Baird?
It comes out of the interest rate, so
Okay.
all the, so if you borrowed 4%, maybe you borrow at 402.
Okay.
You know, it comes, so all the fees like bond counsel, bond attorneys, the rating agency pays for itself. We're not doing disclosure counsel on the ban or the bonds rate, so
Correct.
that doesn't come out. Paying agent associated trusts helps you make your debt payments, so all of it, so none of it is gonna come out of the proceeds. They'll have a full 88 million
Okay.
to spend on
Thank you.
projects, yep. Anything else? Well, thank you again for coming special, I really appreciate you working for on my schedule. But I will be back on the 28th for the 2 resolutions, like I said, or someone from my colleague possibly.
So Lisa will be back, you'll have the 2 resolutions for the ban, as well as for the, to give us for us to open up the availability for the bond issuance as well. And then we will also be bringing forth the proceeds investment side of it, so we'll have a few things that we have to act on that night.
Is it gonna be here?
We'll be here.
Thank you.
Thank you.
you.
So much.
You're welcome.
All right, entertain a motion to adjourn.
So moved.
Need a second?
Second.
Got a motion by Eric, second by Teresa to adjourn. All those in favor signify by saying aye.
Aye.
All those opposed, nay. You're adjourned. Thank you.
All right, what time we get?